Imagine standing at a crossroads, okay? But the signs, they're just spinning, pointing everywhere at once. That's pretty much where the U.S. market is right now, a really critical juncture. Today, we're doing a deep dive, and this is specifically for you, to help navigate these complex, rapidly shifting currents in stock investing. Our mission? Well, it's to give you a clear map, highlight some surprising insights, maybe clarify those confusing opposing viewpoints you're hearing, and deliver an actionable plan for your next 24 hours, basically, in this dynamic environment.
So what's causing all this market whiplash? It seems like we're seeing a Federal Reserve caught in a really tough spot.
Yeah, almost paralyzed, you could say.
Right, by this real threat inflation that could be sparked by new tariffs. And they seem unable to commit to rate cuts, even though the economic data is kind of whispering about a slowdown.
Exactly. And then you throw in today's triple witching options expiration.
Oh, yeah.
And the Russell reconstitution is just around the corner, too. So that adds another layer of, let's say, non-fundamental volatility, which means any big moves you see are probably going to be sharp, right? Driven by specific catalysts.
Absolutely, catalyst-driven.
So our core view for this deep dive is really to lean defensive. Focus on individual stock opportunities, what we call idiosyncratic alpha, rather than just, riding the whole market wave. In fact, we're actually assigning a, 45% probability to a scenario we're calling a hawkish realignment.
That's a great setup. And, to really understand why things are so complex right now, we use a framework. We call it Bayesian inference plus scenario planning.
Okay.
Think of it simply as, constantly updating our market with new information, and then, based on those updates, drawing out the most likely paths forward.
Okay, so if we're updating the map, what did the old map look like? And what's the new info that's forcing us to redraw it?
Excellent question. The market's prior belief, basically what everyone thought was going to happen, was largely a smooth, soft landing for the economy.
Right, the consensus view.
Yeah, and a pretty clear path to, say, at least 2 interest rate cuts in 2025. But then, a series of significant new pieces of evidence, let's call them shocks, hit the system. First, and this was a major development, came from the Fed itself. Governor Christopher Waller's unexpected comments.
Ah, yes, last Friday.
Exactly. Last Friday, in a CNBC interview, Waller actually suggested the Fed could cut rates as early as July.
Which sounds pretty dovish.
It is, and it's a really big deal because it's a direct contrast to the much more cautious tone Fed Chair Jerome Powell struck just, 2 days before that?
Right.
So this creates a high degree of uncertainty. It really hints at a potential split within the Fed committee itself about, where they're heading.
So you've got Waller talking about potential cuts soon, but then Powell seemed to tie future policy to something totally different: tariffs. How do we square that circle?
Yeah, that's a prime example of the conflicting signals we need to wade through. So at the FOMC meeting, June 18th, rates held steady. No surprise there.
As expected.
But Powell's press conference afterward was crucial because he explicitly linked future Fed policy to the inflationary effects of new tariffs potentially from the Trump administration. Now, the Fed's dot plot, their own projections, still shows 2 cuts penciled in. But Powell's caveat, this linkage, it means trade policy, is now a major factor, a primary variable in the Fed's reaction function.
So that's new, a big shift.
It's a substantial new variable for the market to digest, absolutely. And that leads us right into U.S.-China trade relations. While some headlines might have cheered a deal,
Right, you saw those.
the reality is it's more like a formalization of a pretty hostile trade environment than any real de-escalation.
Okay.
We're looking at incredibly high U.S. tariffs, potentially up to 55%, and China hitting back with 10% retaliatory tariffs. And a really critical point, the issue of rare earth minerals.
Vital for tech.
Absolutely vital for U.S. tech, yeah. That remains completely unresolved. So markets, I think they initially misunderstood this, but they've now correctly recognized it as a significant drag on global growth.
Okay, so the Fed's wrestling with tariffs. There's maybe a split in the committee. Global growth looks shaky. What are the latest economic numbers actually telling us? Are they confirming this slowdown narrative?
Oh, they absolutely are. We're seeing fresh, forward-looking data points that indicate a noticeable slowdown. Take the Philadelphia Fed Manufacturing Index for June. It came in at minus 4.0. That was much weaker than the minus 1.0 forecast.
Wow.
Yeah, and it showed sharp deteriorations in business conditions and, importantly, employment.
Okay.
On top of that, the Conference Board's leading economic index, the LEI, for May, it continued its decline. And the 6-month growth rate of the LEI has now fallen to a point that actually triggers the organization's formal recession signal.
A formal recession.
Based on their methodology, yes, that's the flag they raise at this level, minus 2.7% over 6 months.
Then we can't just ignore the geopolitical stuff still simmering in the background, can we?
That's right. I mean, the ongoing conflict between Israel and Iran, it remains a persistent background risk. It's not the primary market driver day to day, maybe, but it certainly contributes to the underlying strength we see in the energy sector. And it provides a bit of a bid for safe haven assets, too, adding, just another layer of complexity to the mix.
Yeah.
So when we connect all this new evidence, you've got Waller's comments, Powell's tariff warnings, the reality of the trade deal, and this weakening economic data. Our updated view, our posterior belief, is that the probability of a Fed policy error has gone up significantly.
Okay.
The market's now navigating this period where political actions like tariffs are effectively tying the Fed's hands, preventing them from responding as they normally might to a slowing economy. Fed helplessness, almost.
That paints a pretty clear picture of, well, uncertainty. So what does this actually mean for the market's direction? What are the most likely scenarios you should be bracing for, say, in the next 24 hours to maybe a week out?
Okay, based on all that, we see 3 high likelihood scenarios playing out. First, and this is our primary concern, is scenario A, hawkish realignment. We're giving this a 45% probability.
Highest odds.
Right. In this scenario, the market starts to really price in the risk that those tariff inflation worries force the Fed to hold back. Maybe fewer cuts in 2025, maybe none. Waller's dovish comments. They get dismissed as an outlier.
And what does that mean for my portfolio?
For your portfolio, it likely means Treasury yields rise, the U.S. dollar strengthens, and those high-growth tech stocks, the ones sensitive to interest rates, they probably see a sharp sell-off. The whole market narrative could shift towards fears of stagflation.
Ooh, stagflation, high inflation, slow growth.
Exactly.
Got it.
And this scenario is strongly supported by Powell's direct warning on tariffs and those very high tariff levels we just talked about. Our second scenario we put at 35% probability is range-bound indecision.
Stuck in the mud.
Pretty much. Here, the market just stays confused. Bullish catalysts like Waller's comments get immediately canceled out by bearish data, like that LEI recession signal. So indices chop sideways mostly. No clear direction.
And volatility.
Volatility gets amplified, especially with today's triple witching. You'd likely see a lot of sector rotation defensive stocks, think consumer staples, utilities, probably outperforming more cyclical ones. And this scenario is supported by the recent mixed market closes and the VIX, the volatility index, staying up above 19. Finally, scenario C, dovish relief. We assign this the lowest probability, just 20%.
The optimistic case.
You could call it that. Here, the market decides to embrace the dovish narrative. It grabs onto Waller's comments, interprets the weak economic data as a clear green light for the Fed to cut rates sooner rather than later.
So risk-on rally.
Exactly, a risk-on rally, probably led by those beaten-down growth in tech stocks. But look, this scenario requires the market to basically ignore the explicit warnings from the Fed chair and the tangible impact of trade policy, which, frankly, seems less likely given everything Powell said.
Okay, so given those 3 potential paths, what's the outlook specifically for the major indices? S&P 500, NASDAQ, the Dow.
Right. For the S&P 500, our outlook is neutral to bearish. Its heavy weighting towards IT and consumer discretionary makes it pretty vulnerable if that hawkish realignment scenario plays out.
Because rates go up?
Because rates go up. Now, defensive sectors like consumer staples, think companies like Kroger and utilities, they'll likely provide a floor, right, and prevent a total collapse. But they'll also cap any significant upside for the index overall. The NASDAQ, though, that's distinctly bearish in our view. As the index most sensitive to interest rate expectations, it's the most exposed if yields rise.
Makes sense.
And we've already seen some cracks, some weakness in the Magnificent Seven big tech names. That signals a potential breakdown in that long-standing market leadership. The Dow Jones, by contrast, is more neutral. Its composition is more balanced, more value-oriented sectors in there. So it might actually outperform the NASDAQ on a relative basis if we get a risk-off move, but still likely range-bound overall. Look, what's really happening here is the Fed's caught between its 2 main jobs, stable prices and maximum employment. They're being pulled in opposite directions.
The dual mandate dilemma.
Precisely. They're effectively allowing the economy to slow down, knowingly, to guard against a political risk, the tariffs, and that dramatically increases the odds of a policy mistake.
And then you layer on today's option stuff.
Exactly. Layer on triple witching, the Russell reconstitution, you've got significant volatility being injected just from market mechanics, not even fundamentals. It's a perfect storm, really.
So with this incredibly complex macro picture, I mean, where do you actually find the most compelling opportunities? Let's talk about how these 5 specific stocks got chosen for your actionable plan today.
Yeah, our selection process, it isn't about just chasing headlines, you know? It's built on what we call first principles plus chain of thought reasoning.
Okay.
Basically, each stock is chosen because it combines a fresh catalyst, maybe an unexpected or anomalous market reaction, and a clear emotional or positioning driver behind it. So the 5 we landed on are Apple, which is a real battleground stock, caught between all these conflicting forces.
Yep.
Nvidia, the AI leader, obviously huge momentum, but facing those geopolitical risks we talked about. Carpenter Technology, CRS, that's more of a pure play on fundamental momentum, plus it has intriguing short interest dynamics.
Okay.
Vigil Neuroscience, VIGL, that's a clear event-driven situation, basically an M&A arbitrage play. And finally, GameStop, GME, the archetypal meme stock, where the price often seems totally disconnected from fundamentals, driven almost purely by social media hype and positioning.
All right, let's get specific then. For each of these, we actually found some really interesting conflicting signals. So how do we make sense of them? And most importantly, what's the concrete plan for you, the listener? We'll use our conflict resolution framework for each one. Let's kick off with Apple, AAPL. We saw some key momentum indicators, like its MACD flashing bearish signals recently. But then, oddly, it rallied over 2% on Friday, when a lot of other big tech stocks were actually falling. What gives there? What caused that?
Yeah, that's a classic example of needing to weigh tactical signals against the bigger strategic picture. The most powerful and, I'd argue, immediate signal here is the overarching macro environment specifically. That 45% probability hawkish realignment scenario.
Okay.
In a risk-off environment, which that implies, a mega-cap tech stock like Apple with its significant geopolitical exposure, U.S.-China tariffs, questions about iPhone growth, the Vision Pro maybe not taking off as hoped, a new AI lawsuit.
Lots of headwinds.
Exactly. It's inherently vulnerable. Friday's strength, it was likely temporary, maybe driven by options expiration dynamics, maybe a brief flight to perceived quality within tech, but it's probably unsustainable if Treasury yields really start climbing again. So for Apple, our primary bias is bearish. In a bearish scenario, which we see as 60% probable, we'd look for a trigger below $196.85.
Okay, specific level.
Yep. Confirmation would be seeing the broader S&P 500 trading below its VWAP, that's the volume-weighted average price for the day, and seeing 10-year Treasury yields rising. Our target would be $194.27 with a stop loss just above $199.20. That gives you a risk reward of about 1.2 to 1.
And the bullish case.
For a bullish scenario, which we put at 40% probability, you'd need a trigger above $201.70. Confirmation, a broad market rally, strengthen the tech sector ETF, XLK. Target then becomes $205 with the stop below $198. That's a risk reward around 1.8 to 1.
Okay, next up, NVIDIA. NVDA. On the one hand, you hear about massive institutional calls buying big players, betting on it going much higher, and obviously its powerful momentum near all-time highs.
Yeah.
Hard to ignore. But then, on the other hand, its short-term technical indicators are apparently flashing a strong sell, and there's that lingering China chip restriction risk hanging over it.
Yeah.
How do you reconcile that tug of war?
Well, what's fascinating here, and this is a really crucial distinction you need to make, is when that institutional call buying is for.
The timing.
Exactly. It's primarily for long-dated options, often expiring way out in 2025 or even 2026. That signals a strategic, long-term bullish view. It doesn't necessarily tell you what happens tomorrow or next week.
Right.
For a 24-hour to 1-week forecast, the tactical signal takes precedence. And the most recent impactful signal is that technical weakness starting to appear right at a key resistance level near its all-time high, around $149.41. And this is happening even with a recent Barclays analyst upgrade to $200.
So the short-term picture looks different.
The long-term bullishness doesn't negate the potential for short-term vulnerability or a pullback. So for Nvidia, our primary bias right now is actually bearish, looking for a short-term pullback. In a bearish scenario, 55% probability, we'd look for a trigger below $143.12.
Okay.
Confirmation would be weakness in the NASDAQ 100 and selling pressure in the semiconductor sector. You can track that with the SOXX ETF. Our target would be $140.85, which was its low back on June 13th. Stop loss above $146.17. That gives a risk reward of about 1.2 to 1.
And the bullish side.
Bullish scenario, 45% probability. Trigger above $146.20. Confirmation. Need to see high relative trading volume on that breakout, plus broad tech sector strength. Target then becomes $149.41, the all-time high. Maybe then $150 psychologically. Stop goes below $144 for a risk-reward of about 1.5 to 1.
Right. Carpenter Technologies, CRS. This one seems, well, maybe a bit more straightforward compared to the others. What's the core story here?
You're right. This one does feel much clearer. CRS is what we'd call a pure play on fundamental momentum. Its price is being driven directly by its strong business performance.
Makes sense.
And you see it in the charts. All the key technical indicators are aligned bullishly. The stock's up, what, over 45% year to date? And an incredible 145% over the past year.
Wow.
Yeah, it's fueled by strong earnings results, positive analyst upgrades from big names like JP Morgan, and critically, it has a high short interest, over 10% of the float.
Ah, the short squeeze potential.
Exactly. That high short interest creates the potential fuel for a short squeeze. If the stock keeps rising, those betting against it might be forced to buy shares back to cover their positions, pushing the price even higher, faster. So it's a compelling story where its individual performance could really stand out, even if the broader market is shaky. So our primary bias for CRS is firmly bullish. In a bullish scenario, 65% probability, we're looking for a trigger above its 52-week high of $256.52.
Breaking out.
Breaking out. Confirmation would be seeing trading volume at least 1.5 times its 30-day average, and ideally strength in the broader materials sector, too. Target, $275, which is actually a minimum analyst target. Stop loss below $248. That offers a strong risk reward, about 2.2 to 1.
And if it fails?
The bearish scenario, 35% probability, would be a failed breakout at that 52-week high, followed by a close back below $250. Confirmation, broad market weakness hitting cyclical stocks. Target then becomes $235 with a stop just above $257. Still a decent risk reward around 2.1 to 1 there too.
Okay, Vigil Neuroscience, VIGL. This stock had, a staggering 324% return in just 30 days. That catches your eye.
Yeah.
Should you be jumping in now trying to catch that wave?
Yeah, that's a huge move. But the short and clear answer here is no. We don't recommend a directional trade on VIGL at this point.
Okay, why not?
Because this is a pure M&A arbitrage play now. Sanofi made an $8 per share cash offer back on May 22nd. Plus, there's a CVR, a contingent value right, which is basically a potential future payment tied to certain drug milestones.
Right.
So its price is now tightly anchored just below that $8 cash offer. While retail sentiment on platforms like StockTwits did surge to extremely bullish.
Yeah, I saw that.
That was really a lagging indicator. The main price move already happened when the deal was announced. The primary drivers now are arbitrageurs, professionals who profit from the small gap between the current price and the deal price, assuming the deal closes. Not fundamentals, not momentum.
So the easy money's gone.
Pretty much. The risk reward for a directional trade now, trying to ride it higher, is exceptionally poor. Very little upside to the $8 cash, and risk if the deal somehow falls through. The only remaining speculative element is that CVR, and that's highly speculative and a very long-term bet, not a tactical trade. So our action plan for VIGL is simple. Avoid this stock for tactical trading purposes. It's become a crowded trade. The main move is done. Very limited upside left and high risk for any new directional bet.
Okay, makes sense. Finally, GameStop, GME. The quintessential meme stock, right? Everyone knows it. Its actual business fundamentals look pretty dire, let's be honest.
Fair assessment.
Yet, it's a huge favorite of retail traders. We see massive bullish call option positioning. So the million-dollar question on everyone's mind is it going up or down?
Look, traditional analysis, frankly, it mostly fails with GameStop. It just doesn't apply in the usual way.
Right.
This stock's behavior is almost entirely a function of sentiment-driven flows from retail traders and a very unique market structure defined by extremely high short interest reports vary, but somewhere between, say, 11.6% and maybe even 23% of its tradable shares are shorted.
Which creates that coiled spring you mentioned.
Exactly. It creates this coiled spring effect. It exists in a state of almost quantum superposition, simultaneously poised for a massive upward squeeze and a potential collapse if sentiment shifts. That massive call option open interest, where so many are betting it will rise, can absolutely create a gamma squeeze.
Explain that quickly.
Sure. Market makers who sell those calls have to hedge their risk. If the stock price shoots up towards the strike prices of those calls, the market makers are forced to buy shares themselves to stay hedged. That buying forces the price up further, which forces more buying.
Yeah.
You get the idea. It's a feedback loop. So while our own AI model is technically neutral on GME, the flow data, the positioning data, it clearly points to an extremely high potential for violent price swings in either direction. So for GME, our primary bias is neutral overall, but it's absolutely a volatility play. This needs to be viewed strictly as a volatility trade, not an investment.
For experienced traders only, maybe.
Definitely. For a bullish scenario, let's say 50% probability of a sharp upward move, a trigger would be seeing it trade above the pre-market VWAP, maybe around $23.52 on high volume. Confirmation would include a surge in social media mentions, Reddit, X, etc., and a rapid increase in call option trading volume. Target could be $28.54, then maybe $35. Stop loss below $21.50. The risk reward here is potentially huge, like 6.0 to 1, but so is the risk.
And the bearish.
Bearish scenario, also 50% probability of a sharp downward move. Trigger, failure to hold support around $22 on significant volume, confirmation. A sharp decline in trading volume, maybe negative shift in social media sentiment. Target could be down near $18.78, stop above $24. Risk reward there about 1.6 to 1. High risk either way.
Okay, this is where it gets really interesting, I think. Beyond just the individual stock trades, what are the bigger, maybe hidden underlying forces at play here that you really need to understand? These are those second-order, third-order effects, the potential aha moments that can redefine how you see the market.
Absolutely. This is crucial. Let's dig into what we're calling the tariff paralysis feedback loop. So the first order effect is simple, right? New tariffs on imported goods will likely lead to higher consumer prices, inflation.
Okay, obvious enough.
But here's the aha moment, the second order effect. It's the fear of this potential inflation that's causing the Federal Reserve to delay interest rate cuts. Cuts that might otherwise be perfectly justified by that weakening, forward-looking economic data we talked about, the LEI, the Philly Fed survey.
So the threat is the problem.
Exactly. The Fed, in essence, finds itself fighting a political risk, the inflationary impact of tariffs, even as the real economy is showing clear signs of slowing down. They're paralyzed by the potential policy impact. Now, here comes the critical third-order effect. This policy paralysis at the Fed, this uncertainty about their reaction function, it creates a heightened degree of uncertainty for everyone else, businesses, consumers.
Makes sense. Hard to plan.
Right. And that uncertainty itself acts as a brake on the economy. It suppresses capital investment. Businesses hold back. It suppresses discretionary spending. Consumers get cautious. This creates a potentially dangerous, self-reinforcing negative feedback loop.
So the threat of inflation is causing the very economic weakness
that the Fed's policies are normally meant to prevent. Precisely. This dynamic significantly increases the perhaps unpriced risk of a hard landing or even a policy-induced recession down the line. It's a truly concerning paradox you need to be aware of.
Wow. That tariff paralysis idea is a huge insight. Okay, what about the GME contagion risk?
Yeah.
How could a single, frankly, kind of weird meme stock potentially affect the entire market? This feels like a real sharp confrontation of ideas, doesn't it?
Yeah.
Challenging how we normally think about risk.
It absolutely does, because it defies conventional diversification wisdom sometimes. So, first order effect. GameStop's price is just extremely volatile. We know that.
Yeah.
But the aha comes with the second order effect. Think about what happens if there is a sharp, unexpected upward squeeze in GME's price. It would inflict massive, very concentrated losses on certain institutional players.
Cool.
Primarily market makers who sold all those call options and certain hedge funds known to be heavily short the stock or short volatility around it. We're potentially talking about major firms here like Citadel, Susquehanna. Now, the third order effect is where it potentially becomes systemic. To meet the sudden and potentially enormous margin calls resulting from those GME losses,
They need cash fast.
they need cash fast. These highly leveraged firms would likely be forced to liquidate other completely unrelated positions in their portfolios. And what do they sell first?
The easy stuff to sell. Big liquid stocks.
Exactly. The most likely targets for this forced selling are highly liquid, large cap stocks. Think Apple, Nvidia, Microsoft, the stocks they can sell quickly without moving the price too much initially. So, a GME squeeze should not be viewed as just an isolated event in some quirky retail stock.
It could spill over.
It's a potential systemic catalyst. It could trigger a wave of forced deleveraging across the entire market, leading to a sudden, sharp, and widespread risk-off shock that seemingly comes out of nowhere. It's a very real, though maybe low probability, tail risk that could redefine how you think about portfolio construction and hidden correlations.
Okay, so bringing this all together, tariff paralysis, GME, contagion risk, the specific stock setups, what does this actually mean for your strategy right now? How do these trade ideas we've discussed rank in terms of overall advantage for you?
Right. When we map out all the pros and cons, weigh the probabilities and risks, our highest conviction setup right now is actually going long on CRS, Carpenter Technology.
The momentum play.
Yep. It presents that rare alignment, strong fundamental momentum, a clear bullish technical trend, and that structural short squeeze catalyst. It offers alpha potential that seems less correlated with the broader market's messy direction right now. Second, we'd rank shorting Apple. This trade aligns directly with our primary macro scenario, that hawkish realignment. The technical picture is leaning bearish, and the company faces real fundamental headwinds from its China exposure, legal issues, etc. It serves as a pretty sound tactical hedge against a broader risk-off turn. Third is tactically shorting Nvidia. Now, this is lower conviction, right? It's a counter-trend trade against a powerful long-term story.
Playing the tape a bit.
Fighting the tape a bit, exactly. But those bearish technicals appearing right at that key resistance level are compelling enough for a short-term pullback play, even acknowledging the strong underlying institutional bullishness. Fourth is the prudent strategic decision. Avoid VIGO, just step aside. This allows you to pass on what's now a crowded M&A arbitrage trade where the main move is done. You preserve capital, avoid exposure to a binary outcome with very limited upside left anyway. Smart not trade sometimes. And finally, GameStop, GME. It ranks lowest for a directional bet conviction. This should be viewed strictly as a volatility trade, pure speculation, not an investment. It's really only suitable for highly risk-tolerant, very tactical traders who have a specific strategy for managing extreme, unpredictable price swings. High risk, high potential reward, but not for everyone.
So there you have it. You just got a deep dive into what feels like the market's most critical juncture in a while. We've tried to distill some really complex information, conflicting viewpoints, into clear insights, and hopefully an actionable plan for your next 24 hours. Understanding concepts like that tariff paralysis feedback loop and the potential, however small, of GME contagion risk, that's absolutely key to navigating this environment, we think. It leaves you with a question, though. In a world where political actions can literally handcuff central bank monetary policy, and where retail sentiment shifts can potentially trigger systemic market shocks, how do you even redefine safe investing anymore? And, maybe more importantly, what overlooked connections, like the ones we discussed, might redefine your portfolio next? Make sure you subscribe for the fastest and most frequent updates from us, especially right now. It's the best way to stay ahead in this incredibly dynamic, fast-moving market.